I think that this correction, and we highlighted it in September 17th, Steve was on the set, we did it on Fast, but, you know, the market was ripe for a correction. I think this correction has a lot more to do with excessive optimism. You had more than 60% of Investors Intelligence newsletter writers bullish. You had a VIX at 12, and you had a historically overbought intermediate-term condition. So from a tactical standpoint, it was a market that was set up looking for a reason to sell. And while a lot of folks are blaming the emerging markets, I just did a little bit of research. I want to get it right because this is really kind of highlighting it. I've talked to 3 accounts since I did this, and they're like, really? It was up that much? The emerging markets from the low of February 2016 to the peak in January of this year were up 86%. You're up 86%. You were up 16% just in the last month of the rally going into the January peak. And now we're down 25% of that. In January, everybody it was rolling off their tongue, synchronized global recovery. That was the peak. Now I think that we think it's definitely getting a little bit overdone to the downside. You've removed some of the excessive optimism. Obviously, you've spiked the volatility, and the extreme overbought condition is being relieved. The bottoming process is difficult, and it's very painful. It sure feels painful right now.
Well, that was the January pullback. We had a June pullback, and we're right in the midst of another one at the moment. Stephen, how is this one relative to the most recent ones in terms of where we are on the technicals, the daily moving averages?
So I think the market has told us that the 200-day moving average, 2768, is the most important level to watch. That's the one to be cognizant of. But to Tony's point, you're running out of daylight between now and year end. So there's going to be a catch-up in performance. Problem is, when does it happen? Truly feels to me like funds are sitting on their hands waiting to see whether it's real or not.
And I don't think end, you mean a little further pop up?
Yeah, I mean the number one concern amongst funds, it used to be trading trade wars. Now it's clear that it's rates. Rates is not going to be resolved in a month or two. Rates is an ongoing robotic move higher in rates, where China trade could be resolved in a month.
Well, who knows about that? And Jack, maybe you could bring all the international elements into play here. You've got this huge China bounce overnight. Saw the currency rebound, 4% gain for Chinese stocks. Concerns, though, still about trade, about Saudi Arabia, about Brazil, about Italy. How does all of that impact the bond market, which it sounds like from Steve is going to give cues to the equity market?
Well, you know what? If Santelli were sitting right here, he'd say what I'm about to say. There is one market to pay attention to, and that is probably the dollar index. Take a look at the dollar index. It's now taken out 96. The dollar index is basically the entire emerging markets trade. It's one of the reasons that we've been seeing weakness there every time you see the dollar go higher. And it's something that we're going to have to probably deal with for the rest of the year because of repatriation. Remember, you're bringing home $1.5 trillion. Those are not dollars that are sitting abroad. Those are sitting in other currencies. They're dollar denominated for the purpose of the corporation. So the swap activity has really put some upside pressure on the U.S. dollar. That is going to continue for the rest of the year. It's going to do two things. It's going to hurt emerging markets continually for the next 3 months, and it's also going to put into question whether the Fed is going to be able to move 4 times next year. All of that is really why we're having all the price dislocation and all the volatility. It's really something that the market's going to have to play out and decide whether the bond market's right or whether the stock market's right.
Tony, are you concerned about the situation in Europe, whether it's Italy, whether it's Brexit terms getting harder or softer, or is it just really the China and EM story that's a concern internationally?
Well, Wolf, I think it was all of those things that when we came into September and the trade and tariff fear kind of kick-started all that. Then you got the Italian yields to blow out. But I think it's really seriously important that if you guys think of your careers and all the viewers think of their careers, the only time you wanted to sell, you wanted to get defensive on weakness that has already presented itself on a spike of volatility is when you have an imminent recession in sight, because Bob did a great job of leading off with the earnings story. The market correlates most closely with the direction of earnings, full stop. So you can have a rate of change in earnings that creates an environment where those things can lead to a correction, 1998, earlier 2011, 2012, 2015, 2016. I've never come on and said we can't have a correction. My point is, what do you do with it? You know, corrections are always considered natural, normal, and healthy until you actually get one. We're famous for coming on talking about how it's going to be a natural correction. Then you get it and we all run away. Until you prove to me that earnings are going to go negative,
Tony,
the international doesn't have that opportunity.
Tom, when you look at rates, though, isn't there a fear that the Fed can be this robotic movement moving forward? I know that it's become in vogue to be less critical of the Fed in the financial markets, but the truth is the Fed can end this rally, can it not?
Yeah, see, when we look at rates, if people like me come on TV or you or me come on TV and say the level of rate that's going to do it, we're making it up. You can never tell which level it's going to be. It was going to be the first rate hike. It was going to be quantitative tightening. It was going to be all those things. Ultimately, it comes down to the environment of credit. When are high-yield debt to Treasury spreads blowing out? When are swap spreads blowing out? When is there real signs of stress in the credit markets?
It's already started. It's already started in the yield curve. It's already started in the yield curve. Pay attention, especially to the 2 to 10-year spread that is stubbornly under 30 bips. Look, you know, the long end of the yield curve is telling you it doesn't believe what's going on.
Jack, let me answer that really quickly. Let's do this. Let's say the yield curve inverts in the next 15 minutes. Historically, your median gain in the S&P is 21% over the next 18 and a half months. 6 out of the last 7 cycles, you had a positive gain from the initial date of inversion. In the last 3, it's 34% over the course of the next 22 months, with the recession 2 years away. So I agree with you. You can have a correction. I'm not debating that. It's whether you buy it or sell it is what investors need to focus on.
Quick final word, Jack.
I think that, you know what, he's absolutely right whether we can see a correction or not. Look, another 100 handles in here in the S&Ps would take us down to a full 10%. That's probably a good place to get in. But the real question is what's going to happen for 2019. Look, if the Fed is going to be aggressive, it's going to stifle any growth, and more than likely we're not going to see an appreciation of more than 5 or 6% in stocks, if that. But the reality is that with the dollar going up, it's going to be very difficult for the Fed to do what they want to do, and that is really what's going to be playing out here and decide whether we're going to see a big year next year.